of our Erode branch of CRSF ICAI, senior members, my dear colleagues, friends, warm welcome to you for today's session, GST input tax credit. And also I warm welcome our today's speaker, our well-known and humble person, our today's speaker, R.Krishna Kumar sir. Few words about our sir. We know well-known person, very humble and calm person. Is very motivator to us. He did the practice more than 15 years, especially in our indirect tax practices. He attested various session in our branches. He's also visiting faculty for to all the our branches in and around the Tamil Nadu. In few words, I welcome to our today's speaker, CA R.Krishna Kumar sir. Sir, welcome, sir. Welcome. Floor is yours. Floor is yours. Kindly take it, sir.
Thank you, sir. Thank you, Chairman. I welcome one and all who are present here for this virtual CPE seminar on insight into ITC. First of all, I would like to thank our Chairman and Managing Committee members for giving me this opportunity to share some of my thoughts on the subject of discussion today. So now we will proceed to the presentation. So coming to the topic, input tax credit, all of you must be well aware that input tax credit is literally an ocean. We cannot afford to complete the entire gamut of legal provisions covering GST Act, GST rules, and all the related area. I have tried to make my presentation as relevant as possible to our practice, which is most applicable to us in our day-to-day practice. Moreover, I have made my presentation in such way that since we have been into GST for almost, we have completed 3 years. 2017 July was the beginning of GST. So now we have almost completed 3 years. So we have been filing various returns. We have been attending various seminars, and daily we are getting updates about the input tax credit, which is eligible, which is not eligible, what are the controversies surrounding it, and various intentions and acts of the accountants who are maintaining the books of accounts, and the clients what they want to claim, or ineligible items what they want to claim, and so on and so forth. So I thought that it would be a right time to just see once again as what the Act says, barely what the Act says. It is just like when we are driving in a state highway rather than a national highway. After a certain point of time, we will be willing to check whether we are proceeding in the right direction or not. At times, those who do self-driving would appreciate the fact. Like that, I just thought we will just make a visit to the bare provisions and see what the Act says, what are the changes that has come recently, and just a plain reading of the Act, so that without giving any of my personal opinions or anybody else's opinion, like that, I just thought of making one session. So our chairman was kind enough to this topic, and he told that we will do it. So that is the way in which it has culminated. So first we shall proceed with further. So today, as I told you, today's discussion will be around section 16, 17 and 18 of CGST Act and CGST rules related thereon, and the recent developments, the circulars, notifications, and what are the developments related to input tax credit. You may be thinking about the other sections which are there in this particular chapter of input tax credit. So like input service distributor and manner of recovering the excess distribution of credit and those things, since it may not be that much relevant, I have not concentrated on those topics. And if members feel that we will be covering the other topics which have been left out today, I would be more than happy to cover it in a separate session. Okay. So the first starting point of today's discussion is section 16. So section 16, 17, 18 are the base sections of input tax credit. First, section 16 talks about the criteria or the conditions which are applicable in order to claim the input tax credit. So section 16(1), it starts with the wordings registered person. So the registered person is eligible to claim the input tax credit. He can claim it in the manner specified in section 49 and in respect of supply of goods or services or both, which are used or intended to be used in the course of furtherance of his business. So the basic condition is the person should be a registered person, and we can claim, the registered person can claim input tax credit in respect of supply of goods or services or both. And the another point is that it should be used or intended to be used in the course or furtherance of business. These are all the basic conditions. How we will be able to claim it and set off while making the liability, it deals with section 49. So these are the first step towards section 16(1). Further describing the conditions, what are the subject to such conditions and restrictions was specified in section 16(1). So what are the exact conditions are given in section 16(2). So there are certain conditions which needs to be seen. So first is possession of a tax invoice or debit note. Possession of a tax invoice or debit note issued by a supplier registered under this act or such other tax paying document. So first we should need to have a tax invoice. The second condition is receipt of goods or services or both. Then the tax charged in respect of that supply has been actually paid to the government, either in cash or through utilization of ITC, and furnish the return under section 39. These are the basic 4 conditions which one must satisfy in order to claim his input tax credit. We will see one by one in an elaborate manner. So the first condition is possession of a tax invoice or a debit note. So basically we understand that there should be some tax invoice in order to claim the input tax credit. So the rule 36(1) says what are the valid documents for claiming the input tax credit. So it may be either of the following items. An invoice issued as per section 31. Section 31 deals with invoice. It prescribes what are the various requirements that should be in a proper invoice. So an invoice as per section 31 is a valid document. An invoice issued as per section 31(3)(f) subject to payment of tax. 31(3)(f) is nothing but invoice which needs to be prepared by a registered person in case of reverse charge mechanism transactions, wherever we are liable to, where the registered person is liable to pay tax on RCM basis, that registered person needs to prepare an invoice. So that invoice is also a valid document for claiming an input tax credit. A debit note issued by the supplier as per section 34, bill of entry or similar document as per Customs Act, an ISD invoice or debit note or any document issued by an input service distributor. Members might have already taken note of the fact that in GST era, the debit note or credit note can be issued only by a supplier of goods or service, not by any other person. So if it is issued by the recipient, it will only be a financial debit note, credit note, but not a GST debit note, credit note. Only a GST debit note or credit note will have the impact towards input tax credit, as well as they can be accommodated in the GST returns which we are filing. So the debit note should have been issued by the supplier as per section 34. So this is with respect to these conditions of possession of the tax invoice or a debit note. So we have seen that there are invoice should be as per section 31. So section 31 says a lot of particulars. It lists out the various items which should find place in an invoice to be considered as a proper invoice by the assessing officer. So all the particulars which are mentioned in the section should be there in the invoice, and along with that, such details, the details of such invoice should have been furnished in form GSTR2 by such person. We are day in day out we are facing the problems of GSTR2 2A. So not only he has a proper invoice, the details of invoice should have found place in the GSTR2. Now in rule 36.2 itself, they have given a relaxation stating that those various particulars need not be, even if those things are not there, still we can consider an invoice as a valid invoice. So the minimum particulars an invoice should have is these 5 particulars, which is given in the rule itself. So even if other particulars are not there, we won't have any problem in claiming the input tax credit. So the first one is amount of tax charged should be there. Description of goods or services, it is a must. Total value of supply of goods or services or both. Then GSTN of both the parties of the transaction. In case of interstate supply, place of supply is a must. So these are all the minimum requirement of an invoice which is permitted by rule itself, so that the invoice will have a proper validity. If at least these informations are also not mentioned, then it will not consider a valid invoice, and the eligibility to claim input tax credit will be at stake. The next condition in section 16.2 is that he has received the goods or services or both. That is the next condition. The supplier is providing the supply of goods or he is providing the service. The recipient the registered person who intends to claim the credit should have received the goods or services. That is the basic condition. So there is no further any relaxation or something like that. But there are certain exceptions to this condition, that even if the recipient, being a registered person, has not received the goods or services, still he will be eligible to claim the input tax credit. If we see what are those 2 exceptions, in preparing the e-way bill, we might have noticed that there is a bill to ship to model. So bill will be in our name, that is a registered person's name, but we might ask the supplier to dispatch the goods directly to our customer or to some other person on our direction. So in such case where goods are delivered to a third party on the direction of the registered person, there is no possibility that we will receive the goods. In such cases, it is deemed that we have received the goods. The condition is considered to have been complied with. Similarly, we are asking, that is the registered person is asking the supplier to provide certain services on our behalf to some other person. In such case, the service provider would have provided service to the third party. In such circumstances also, it is considered that the services are received by us. At this juncture, I would just add a small hint for the problems which is faced in the day-to-day activities of our client. So in case, I think I will, it is in the subsequent slides, when we come to that particular point, I will tell that. Okay. So the third condition is that the tax charged in respect of such supply has been actually paid, either in cash or through utilization of input tax credit admissible in respect of said supply. Actually, this compliance with this condition is not in our hands. Whether presence of this condition in section 16(2) is correct or not is beyond our discussion, because it is already there in the statute. Only the government has to change, if at all it is convinced that the recipient, being the registered person, will not be able to being the registered person will not be able to comply with this condition, because we don't know whether the supplier has paid the tax or he has furnished his GSTR3B, GSTR1, whatever it may be. If he has not filed the GSTR1, we will be able to see that we don't get credit in GSTR2A. But whether he has paid it or not, that we have no control. Moreover, there are clients who properly file GSTR1, but they don't file GSTR3B. Even in such case also, we will get our transaction reflected in GSTR2A, but they might not have paid the tax to the government. And to top of it, they have given that either in cash or through utilization of input tax credit admissible in respect of said supply. The registered person who wishes to avail credit by going through these provisions himself does not know whether his invoice is eligible to claim ITC. So how come he know whether the tax which the opposite party is paying is through the admissible input tax credit? There is no possibility actually for us to comply with this condition. So this condition will be left by all the assessees as such. So the next condition, clause section 16D, clause D, is that the registered person has filed the return under section 39 in order to be eligible to claim ITC. So this is the condition. Actually, what happened of late was that people have started to question the validity of GSTR3B. They have told that GSTR3B is not at all a regular return. It was a stopgap arrangement, so we cannot consider it as a return. Like that, various things were happening. So what happened was that some filing has happened in Gujarat High Court stating that this return itself is not valid. So any input tax availment related issues, that is, the department denies the credit, citing the reason that you have not filed your return or belatedly filed your return, something like that, it will not hold good. Something like that happened, but Gujarat High Court has also ruled in favor of the assessee, stating that GSTR3B is not a valid return. So now what happened is Rule 61(5) is retrospectively amended from July 2017 to make it as a valid return. So thus the judgment has become non-operational. So like that, they might have given, since it is nothing to do with technical aspects, they could have easily make the retrospective amendment. But what every one of us were expecting was the interest payment for the delayed payment of tax, which was on the gross amount, and now it has been changed to net amount. But that could not be made a retrospective amendment. Possibly for the reason which they are stating is that due to technical reasons, if anybody asks the refund, they may not be in a position to give the refund due to various technical reasons associated. So, but as far as this is concerned, they have clearly made it retrospective from July 17 to make it a valid one in order to claim the ITC. So further proceeding into section 16, which states various conditions and restrictions in order to claim the ITC. The next step is that in case the registered person has claimed depreciation on the tax component of cost of capital goods and plant and machinery, ITC is not available on the tax component. So that we are already following it, but while filing the income tax return as well as certifying GSTR 9 as well as other GSTR3B, we need to be sure that, because whenever any GST tax-paying document invoice is received, it is the normal practice of the accountant or the assessee to claim it in that month's return itself. That is the basic thing which most of the people are doing, irrespective of the fact whether it relates to capital goods, personal, or eligible, not eligible, which most of the people are not worried about. So they just claim the ITC as such. In case for any capital goods, including plant and machinery, if they had claimed the input tax credit in the monthly return, that component is not eligible for claiming depreciation as per the Income Tax Act. So either we can claim ITC here or we can claim depreciation in the Income Tax Act. So whichever is beneficial should be the decision of the assessee. So there may be a situation where there may be some doubts regarding the eligibility of ITC. In case of bigger assessees, there may be certain transactions like purchase of some tipper lorries or something like that, where they may have a different opinion stating that ITC may not be eligible. In such case, the thing is that the assessee can capitalize it, claim depreciation on that. When it is confirmed that ITC is eligible on such transaction, again they can claim ITC in GST return, but reversal of the depreciation needs to be made in the books. For that, the relevant transactions should be taken care in the income tax filing. While doing so, we have to keep in your mind that for claiming we are going to teach it. So if the time limit permits, we can do. Otherwise, it will not be possible to change over from depreciation to claiming of depreciation to claiming of ITC. So the next one we will see. (16.4). So 16.4 is a section which prescribes the time limit within which input tax credit can be claimed. So it says that the registered person shall not be entitled to take input tax credit in respect of any invoice or debit note for the supply of goods or services, or both. So after the due date of furnishing the return related to the September. I think most of us will be aware of this provision. So as per 16.4, for the financial year 1920, any credit in respect of invoices can be claimed only up to the filing of September 2020 GSTR3B return, or filing of the annual return, whichever is earlier. So definitely we will be filing our GSTR3B earlier, since now we are just about to file annual return for the financial year 18-19. So 1920 is a long way to go. So up to 30th September return, maybe if the original due date happens to be October 20, so within that date, any invoice or debit note for the supply of goods or services needs to be claimed by the assessee. If he misses this date, there is no possibility of claiming any input tax credit, even if all the other conditions specified in section 16(1), 2, 3 are satisfied. There is no way he can claim those input tax credit. Here it is interesting to see they have specifically given any invoice or debit note for supply of goods or services. So the thing is that there is no time limit for credit note. What is the impact the credit note has? Whenever we get any credit note, we are supposed to reverse the input tax credit. So the government is quite clear that in respect of credit note, there is no time limit. Whenever you receive it, you please reverse it. As far as the debit note is concerned, they have given a specific time. But one concession they have extended in respect of the credit note. Following the end of the financial year, to which such invoice or invoice relating to such debit note pertains, or furnishing of the relevant. That is actually a debit note is given. That debit note relates to the invoice of a particular financial year. Then the due date has to be reckoned only with respect to that financial year as of now. But the Amendment Act has brought a change so that this highlighted portion is deleted, which means that debit note, if it is issued, whatever be the date of the debit note, based on that the year will be determined, and you can proceed with the claiming of input tax credit. Say for example, financial year 18-19 related transaction, but if you have been given an invoice on 1/4/2019, so since as far as 18-19 is concerned, but the debit note is given in the next financial year after the due date is over. Say for example, 18-19 financial year, some 1st December 2019, a debit note is issued. The assessee will not be able to claim that debit note for the reason that it relates to the financial year for which the due date for claiming is over. But kindly note, the highlighted portion has not yet been notified. It is only a proposal. It is already there in the Amendment Act. But unlike Income Tax Act, where all the budgetary amendments and whatever be the Finance Act amendments are brought into force on a single day, here they have the practice of notifying sections, say 3 or 4 sections at a particular point of time during over a period of 6 months, 1 year, or even more than 1 year also. So even 30th June 2020, they have kept a date for some of the sections of Finance Act 2020 and Finance Act 2019 also. Certain provisions are yet to be notified. They have been brought in Finance Act 2019, but it has not been notified. So one of such amendment pending to be notified is this one. If it gets notified, it will be for the benefit of the assessee, irrespective of the financial year. Based on the debit note date and financial year, he would be able to claim it. We have seen the date, the cutoff date within which we need to claim. There is only one exception for this date. Even beyond this date, we can claim. What it could be? So it deals with the section. The rule says that a claim for re-availing any credit in accordance with the provisions of the Act or the provisions of this chapter that had been reversed earlier. Actually, this provision mainly deals with reversal of credit for the case where payment within 180 days has not been made to the supplier. That is one of the conditions which we are going to see. In case the registered person has reversed the input tax credit, since he has not made payment within 180 days, he can re-avail the credit whenever he makes payment, irrespective of the fact that the time limit of that September GST return has already gone. So that is the only exception. But they have given that re-availing of any credit is possible. So if at all the assessee reverses the credit for any particular reason, and subsequently he avails it, that will also be eligible to claim credit. So we can think to use of this provision for any other credit which has been availed earlier and reversed within the time limit, so that we can claim it subsequently. But we need to keep that to a claim for re-availing any credit in accordance with the provisions of this Act or the provisions of this chapter that had been reversed earlier. So only the reversal is to be done as per the provisions of this chapter. If reversal is done, reclaim is eligible without any time limit. So far we have seen section 16, 1 to 4, what are the various conditions. So apart from that, the provisions of these sections provide certain other conditions which needs to be fulfilled. Then only the circle will be complete and we will be able to claim the ITC. What are the other conditions? In case the goods are received in lots or installments, credit is available only on the receipt of the last lot or the last installment. That's a very important aspect. In certain cases, single invoice will be issued, but the goods will be sent in different lots for various reasons, depending upon the nature of industry or the requirement of the buyer or whatever may be the reason. In all such cases, we need to ensure whether the entire lots have been received or not before claiming the credit. Now this becomes, previously there were some doubts in the sense that whether the department will be able to identify these transactions, whether it is only in an only at academic level, so that it is practically not possible to identify. But after introduction of e-way bill, it will be very much possible. In case of maybe if they do data analytics for the same invoice number, same amount of total invoice value, if it happens to be 3 or 4 installments and the amount involved is huge, it would not be a surprise if the assessee receives a notice on this account. It needs to be ensured. So initially, I told that I will share a small hint regarding a point. It is with respect to the lots or installments only. Say, for example, if a particular invoice has 3 or 4 lots of consignment, out of which the last lot could not be received for whatever may be the reason. Either the buyer himself has told that we don't want further consignment, or some accident has taken place, or some fire has happened, something like that. So he might not be in a position to receive such last lot. So what will happen to the credit when he will be able to claim the credit will be a question mark. In such case, the person concerned should insist the supplier should give a credit note in respect of that last transaction, so that the transaction gets completed and the conditions also fulfilled. In such case, they will be able to receive the installment. Similarly, we have seen the criteria that receipt of goods or services is a must. In section 16(3), we saw that receipt of goods or services is a must. There, we saw an exception that the service may be provided to some other person, third party, like that. And another important aspect which we need to keep in mind in respect of receipt of service is that the companies maybe or the assessees may enter into a service contract, say for AMC for the computers or machineries, AC, or something like that. The companies and bigger clients may enter into annual maintenance contract type of arrangement for getting various services. In those cases, it needs to be seen that the billing of those transactions are designed in such a way that they are mainly of quarterly nature instead of being annual. If the billing is annual, and if the billing is received and payment is made, but suppose if we enter into a contract only on 1st November of 2019 for 1 year AMC, we make the payment on 1st November itself, and we deduct TDS as per Income Tax Act. As far as the 30th September 2020 is concerned, the provision of service will not be completed. In such case, we will not be able to claim the credit. So it is advisable to design the transaction in such way that even though it is an AMC transaction, we can make the agreement for payment or completion of service on quarterly basis, so that the service will be completed on quarterly basis. Payment is made in such a way so that the condition that receipt of services is complied with without any hassle. That's one of the point which we may consider in doing our tax planning for compliance of this receipt of services. For goods also, there may be cases where there will be continuous supply of goods. In such case, the contract may be designed in such way for continuous supply of goods with certain agreement in order to make the date when invoice needs to be raised. Whenever an invoice is raised after completion of a certain date or some quantity, something like that, it would be easy for us to identify that the goods have been received and it is becoming eligible for claiming the credit. So that's the point which I thought of sharing with you. The next condition is that we need to make payment to the supplier within 180 days from the date of issue of invoice. Like the condition that the registered person need to ensure whether the supplier has made payment of the tax involved in the tax transaction by cash or by eligible input tax credit of his transactions. This condition is also beyond the scope for the department. Again, we don't know, and we don't have it, it doesn't comes within our jurisdiction to say why they have included this, whether this is correct or not. That we could not discuss, because it will have no fruitful result. So we have to see that within 180 days, if it is not made, payment is not made to the supplier, we need to reverse that input tax credit, and subsequently there will be no time limit. As we just saw, we can reclaim the credit whenever the payment has been made. And if the payment has been made on proportionate basis, we need to reverse only on that proportion to which payment has not been made. As far as the 180 days payment concept is concerned, it is applicable only for the forward charge transaction. In case of RCM transactions, this 180 days concept is not applicable. So it means that if we have received certain transactions on reverse charge basis, and we have not paid payment even after 180 days, there will be no restriction for us to claim the credit. So the condition is increasing one by one. So almost we have reached the last leg, I think, as far as the conditions are concerned. Now the restriction, some of the restrictions in claiming the input tax credit are that there is a possibility that we may get a notice during the course of assessment, or department has lot of ways and means of identifying how we are claiming the ITC. So in case there happens to be any demand and it has been confirmed, and we are also making payment for that particular transaction, which is identified in the notice. And if the notice specifies that this has been due to the fact of any fraud, suppression, willful misstatement, these kind of activities by the assessee, the amount which has been paid as such cannot be claimed as ITC. This is one of the restrictions. So what care we need to take in this aspect, as per my opinion, is that anything which has gone unpaid will be considered by the department as only due to suppression of facts or willful misstatement or something like that. Fraud is a broader sense. So if it happens to be a fraud, they have to prove it. But for the suppression of facts and willful misstatement, they will. It is possible that they will state the reason. And one of the very important reason why the department will take stand of willful misstatement or suppression of fact is that they get 4 years and 9 months to issue a notice, as against 2 years and 6 months in case of a normal omission, inadvertent, without any fraud, willful misstatement or suppression of facts. So they are getting some 2 years and 3 months extra, minimum 2 years extra in case of the fraud cases. So if the department specifies these reasons, the assessee has to ensure whether it is actually a case of suppression of fact or willful misstatement. If it happens to be those cases, we have no other go for. We have to make the payment and we cannot claim any ITC on that. In case if it happens to be a regular case, we have to see that we deny that fact and make it corrected. And while making the final order, we have to ensure that the particular point of misstatement or suppression of fact is omitted, and we have to give all the proof. The end result will be that whatever we have paid, we will be able to claim as input tax credit. If we accept it as such without verifying the facts, then the assessee may lose the demand which is paid for claiming the ITC. So this is the latest one which we are fighting for the quite long time, is that they have made a cap of certain percentage of amount which can be claimed as input tax credit by the persons. So in respect of invoices or debit notes, which has not been uploaded by the supplier as per this section, it should not exceed 10% of the eligible credit. Previously, it was 20%. Now they have made it as 10% in respect of the credit available in respect of invoices or debit notes, details of which have been uploaded by the supplier. So, whatever has been uploaded, I don't know how much of the assessees are following this meticulously, and whether they will be able to follow it or not is another question. But what is expected is that, say for example, 1 lakh is the total amount of invoices the assessee is having in their hands, and 2A shows some 70,000 only. So 30,000 invoices not found. So in such case, so 70,000 we can claim it. There is no issue. And for the balance 30,000 which is not there, restricted to 10% of the eligible credit. So it will be some 7,000. So 77,000 we will be able to claim for that particular month instead of 1 lakh. This is what the intention of the provision, and how we are able to manage these things is it is in our hands. So as far as this 10% is concerned, the government has, due to this COVID pandemic, they have given certain relaxation in complying with various provisions, of which one relating to ITC is that, so they have given the relaxation stating that this working of that 10%, which we just saw as an example, can be cumulatively worked from the month of February 2020 to August 2020. We need not make it for each month. We can take it as a cumulation for all the month. What is the invoices on hand? What is the cumulative 2A figure? How much is eligible? How much is not eligible? We have to adjust everything in the September return. So while filing the September return, we have to see that the eligible plus 10% only is claimed. If any, we have claimed more, then we may have to reverse it. So now we have primarily covered section 16 thoroughly, I believe. What are the various conditions, restrictions in claiming the input tax credit? So the next issue comes is that cancellation of registration. Now, again, as a part of relaxation due to this COVID pandemic, government has given two important relaxations or concession to the assessees. One is that those who have not filed their returns so far can file up to February 2020 return with a late fee of nil. I think for a nil return, no late fee is charged. For other returns, a total of 500, both CGST and SGST included, is collected from the assessees. They can make the payment and they can make the returns regular. Then, in case of the persons, for the last 1 year, there have been a lot of cases where the what do you call it as this registration of the assessees have been cancelled for the reason of non-filing of return. In some cases, the assessee have given reply. Even in those cases, they have some cases they have considered the reply, and some cases they haven't considered the reply. So they have cancelled, and some of the assessees are in such position that they don't know their RC is cancelled, already cancelled, unless someone visits the search taxpayer and sees that your RC is already cancelled. Some of the assessees don't know that their RC is already cancelled. So this is the position. So for that, the notification has been given by the department stating that application for revocation can be filed by the assessee, so that he can again file the pending returns, and he can proceed with the further business. Now, there are certain important aspects which we need to take into account as far as the cancellation of registration is concerned. One is that section 29(5) says whenever a registration is cancelled, as on the date preceding the date of cancellation, whatever input tax credit is there in the electronic credit ledger shall be reversed by the assessee, subject to the fact that the output tax payable on the same is less than the ITC available. whatever stock or whatever ITC is there in the book, say for example, some 50,000 IT is left the day before the cancellation of RC, and the stock held in hand is such that the tax payable on that is 48,000. So this 50,000 needs to be reversed. If the tax payable on that goods is 60,000, then he has to pay 10,000 from his hand. That is the provision. So minimum, this 29.5 says that whatever is there in the input tax credit will be the electronic credit ledger will be reversed. That is one point. The next point is that, as we have already seen in section 16.1, only a registered person is eligible to claim and claim input tax credit. So once on a particular date the RC has been cancelled, the next date he will be considered as a person he is not registered under the act. But without knowing the fact, he would have been kept on receiving the invoices giving his GSTN number. The supplier would have also promptly uploaded in GSTR1 in these cases as per Murphy's law. Because in the regular cases, we might have be seeing the missing invoices. But in these cases, we can find that he might have correctly uploaded. But the question is that since he is not a registered person, whether he can claim those ITC. That's an important question which needs to be answered. Similarly, the reversal of ITC, what will happen? So say for example, if we apply for revocation of cancellation and we utilize all the ITC available and we claim the ITC whichever is eligible as per the 16/4 September due date which we saw just now, everything is over. But subsequently, after 1 or 2 years or up to 5 years, what is the maximum time they are having from the due date of annual return? If the department comes to us and says that both ITC on the electronic credit ledger on the date of cancellation, as well as the whatever ITC you claimed in between the date is totally ineligible, then what will be our position? Whether government will give any clarification on this is awaited. So as of now, I think it is whenever we go for any revocation of cancellation, I think that we should advise our clients regarding the possible notice which he may receive, which needs to be taken care at that point of time. Because we cannot ask the assessee to reverse everything and not to claim ITC and pay tax only on outward supplies. That is practically not possible. We have to wait and watch what the department does after revocation happens. So there are certain important definitions which we need to take into consideration as far as the input tax provisions are concerned. One is the capital goods. So the definition of capital goods is such that 2+19 says value of which is capitalized in the books of accounts of the person claiming the input tax credit, and again which are used or intended to be used. So the definition is that if we capitalize in our books, that will be considered as capital good, irrespective of the fact whether it is a capital asset or not, as per the normal accounting parlance and standards. So that we need to keep in our mind. Then as far as the definition of input is concerned, input is defined as any goods other than capital goods. So the definition are quite simple. Whatever we don't capitalize in the books will be considered as input. So now we have come to the next section, 17. So 17 deals with mostly deals with the credits which are not eligible, or out of availed credit, what is the portion of credit which is not eligible for the assessee. So section 17 deals with these two things primarily. We will see one by one. So there is a possibility, say for example, the supplier may be the registered person if he provides only taxable supply. Section 17(1) and 2 will not have no role to play because he will have totally taxable supply. So whatever he claims as input tax credit, he can utilize those input tax credit. The next possible scenario is that the person is providing only exempt supply. The third possibility is that, which will be seen in most of the cases, they will be providing both taxable as well as exempt supply. So what should be done for those things? So when the goods and services which are procured by the registered person are used partly for business and partly for other purposes, the other purposes is it is a wide range. Maybe it is for the personal purposes or not used in the course of the business or anything other than for the taxable supply. So the credit shall be restricted to the input tax as is attributable to the purpose of his business. So if the input of services and goods availed are not for the purpose of the business, then those credits are not eligible. That is the first point which we need to take into account. The next one is that the supplies which we are procuring is partly used for taxable supplies. So taxable supplies includes zero rated supply to SEZ and exports. Everything is covered in the zero rated, even though no tax is payable. And partly for affecting exempt supplies. Credit shall be restricted only in respect of taxable supplies, including zero rated supplies. So we have to consider in cases where the turnover of the assessee includes both taxable as well as exempt supply, a reversal of input tax credit assumes much significance. Without that, there is every possibility we will get a notice for the same. So I will just give a, actually it comprises of formula. You might have be already using those things. I will just describe a few of the issues concerned with rule 42 and 43. In case the goods and services which are procured is exclusively for personal purposes, they are not at all eligible. If they are exclusively related to the exempt supply, they are not eligible. Input tax credit which are exclusively related to the taxable supply, they are totally eligible. So from overall gross input tax credit, if we remove all these items, whatever we have in balance is called as the common credit. Say for example, our audit fees or some software expenses, whatever with the common expenses which have been done. In those cases, first we have to arrive at the common credit. In the common credit, what is the ineligible portion is that common credit multiplied by exempt supply divided by total supply. That is our total outward supply. So that is the portion which is ineligible. That portion we need to reverse it. Similarly, for capital goods also, whenever we are making an outward supply of capital goods, that we will see it later in section 18, we need to make payment of GST, which we need to ensure in our day-to-day routine. So as far as the important definition concerned for section 17, there are zero rated supply and exempt supply, which we have seen. So partly used for affecting zero rated supply and partly for affecting exempt supplies. Okay. So the zero rated supply means any of the supply goods or services are both, namely export of goods or services are both, or service or goods supplied to a SEZ developer or SEZ unit. So this is considered as zero rated supply, but the credit is eligible for zero rated supply. We need not reverse for the zero rated supply. Exempt supply. Exempt supply means supply of goods or services are both, which attracts nil rate of tax or wholly exempt from tax under section 11 or under section 16 and includes non-taxable supply. So this is a very crucial definition. Exempt supply on the name may suggest that it is only a supply which is exempted, but the actual definition is not like that. So it includes three parts. So which is nil rate and which is wholly exempt, and the last one is non-taxable supply. Non-taxable supply is which is not at all in the GST net, should also be considered in order to arrive at the exempt supply. Then we have to arrive at the what is the component of input tax credit that needs to be reversed, which is attributable to the exempt supply. For this purpose, value of exempt supply, it has been clarified that it will include the following also. Supplies on which recipient is liable to pay tax on reverse charge basis. It means that the registered person, say for example, the registered person provides goods transport agency service. The registered person, in those cases, the tax liability will be on the person who is receiving the service. In such case, the turnover of this goods transport agency on which the recipient will pay tax will be considered for the purpose of exempt supply. Then transaction in securities, if we do any transaction in securities, that is also considered, because securities has been what are the goods as per the definition of goods. So money and securities, it has been excluded. So the securities will also be considered as exempt supply. And the section and the rule 44 and 45 prescribes that 1% of the value of sale value of the security should be considered as value for arriving at this exempt supply. Sale of land and subject to clause B, paragraph 5 of schedule 2, sale of building. We might have already seen that if we make a sale of building after receiving the completion certificate, that will not be considered, that will be considered neither as a supply of goods nor as a supply of service. But in other cases, all other cases, it will be considered as a supply of service. So schedule 2 actually deals with the cases of identifying whether a particular activity is a supply of goods or a supply of service. It specifically gives these items are goods, these items are service, which was a very big drawback under the old service tax regime. We don't know whether it will be a service taxable under Service Tax Act or it is a goods taxable under VAT Act. Now, Schedule 2 makes that point very clear, stating that these items are services, these items are supply of goods. So, in case sale of building which is done before getting the completion certificate, it will be considered as a service. So, in such case, it will also be included as part of exempt supply. So, in section 17, after reversing the ineligible portion for personal purposes or not for the purpose of business, and also for the exempt supply, taxable supply portion, now section 17 talks about blocked credit. So it is one of the important area regarding the credits which have been specifically blocked by the act itself. Again, here we cannot question the reason why they have been included in the blocked credit, whether this is correct or not. Those things, it goes beyond our discussion. So we can see what are the items that is blocked, and we see that such items are not claimed by our assessees. We don't at least recommend those items to be claimed. So may I request the chairman to go for a small break of maybe 5 to 7 minutes, and again we can reassemble.
Yes, sir. Please, sir, please take your 5-minute break, sir.
5 to 7
Members
minutes.
are requested to rejoin with meeting exactly 5:37.
Yes, sir. Okay, sir.
Okay, 5:37 we will be rejoined, sir. Thank you, sir.
Thank you. Thank you, sir.
Satish sir, kindly close our PPT. Thank you all the members for patient waiting. Thank you for your cooperation. Krishna Kumar sir,
Yes, sir.
shall we take your session?
Yes, sir. We shall continue, sir. Yes. Yes. So now we proceed with blocked credit, section 17, subsection 5. Blocked credit, as the name suggests, the items which are included in this subsection are not eligible to claim ITC, irrespective of the fact whether it is used in the course or furtherance of business, or it satisfies the conditions which are listed out in section 16, various conditions listed. So irrespective of those facts, if a particular item is found in 17.5, it is blocked simply. So the first item which we pursue is that motor vehicles and conveyances. So there is a blanket ban for motor vehicles and conveyances. The reason which we have to see why it has been blocked. But there are certain exceptions for the motor vehicles and conveyances. First is for the transportation of goods, it is eligible. Motor vehicle with seating capacity 13 or less. If the seating capacity of the motor vehicle is 13 members or less, this 13 includes driver, then it will be available only to these three categories of the assessees. First, who are making the further supply of such conveyances, who are involved in the transportation of passengers, or who are involved in the imparting training on driving, flying, or navigating such vehicles or conveyances. So for these three persons, motor vehicle with a seating capacity of 13 or less is available. Then motor vehicle with a seating capacity of 14 or above is available to all. Say for example, a spinning mill has bought a bus for the transportation of his staff and laborers, and the seating capacity is 20. Then that vehicle is eligible for claiming input tax credit. The same company, if it buys a vehicle which has a seating capacity of say some 407 or tempo traveler vehicle, where the seating capacity including driver is 12, but it is used only for transporting its officials to and from the company, it is not eligible. So the thing is that we need not apply much logic or common sense. If the condition is not complied, we can leave it as such, and we will leave it as such, but it is only our clients who don't want to accept the facts given in the provision. I believe member will agree to this point. Sorry. Okay. The next issue is that since motor vehicle is already made as a blocked credit, the related items, say for example, the general insurance, servicing, repair and maintenance, all these things crop up. So initially there were two different opinions stating that the section 17.5 blocks only the motor vehicles with the conditions to whom it is applicable and not applicable. It has not provided anything regarding the general insurance and the servicing, all other activities connected with the motor vehicle. So there were two opinions. One was that we can claim those things. The other was that we cannot claim, being more prudent. But now in 2019, the department has made it very clear by making the necessary amendments in the section itself, stating that insurance, servicing, repair and maintenance related to motor vehicle will be available in the same way as credit for the motor vehicle is eligible. So the meaning of this statement is that If a particular motor vehicle is eligible for assessee, the related items for its maintenance and other ancillary items will also be eligible. Say, for example, a car purchased by a company for its MD, it is not eligible as per section 17(5). In such case, insurance, servicing, and repairs and maintenance of those car is not eligible. That needs to be understood. Then, this general insurance and other activity is available to the persons engaged in the manufacture of such vehicles. That is very important. If they are engaged in the manufacture of such vehicles, they are eligible to get these credits. And to the general insurance companies, because the general insurance companies providing general insurance will be their outward supply. So they will be eligible to claim the credits related to those things. Then credit for the renting, leasing, or hiring of motor vehicle. This is another category. To whom it is available? When these activities are used as inward supply to make same outward supply. So the renting, leasing, or hiring of motor vehicle is done by a person so as to provide the same kind of activity as an outward supply. In such case, credit is available. Then to an employer, if it is under a statutory obligation. In case of a statutory obligation, renting, leasing, or hiring of motor vehicle is available to an employer. Say, for example, the big IT companies or whoever it may be, employer on a voluntary basis provides the hiring of motor vehicles. He hires the motor vehicles and provides transportation of their staff and laborers to and from the company or to and from their home. Then the credit will not be available because it is on a voluntary basis, not on a statutory obligation. You might have come across that in some IT companies, certain governments like Karnataka government and certain governments have made it obligatory on the part of the employer to see that their women employees are with proper security dropped at home. In case they go by late night or something like that, some certain statutory obligation has been caused on the employers. In those cases, they can very well claim the input tax credit. In the same way as credit for motor vehicle, this is the third item. So in case if for those persons who for whom motor vehicle is eligible, the further renting, leasing, hiring of motor vehicle is also available. It is important to see what is the definition of motor vehicle. So far, we might have heard that motor vehicle is not eligible, why car is not eligible, all those things. But what is the definition given? We need to see. So it says that same meaning as assigned in section 2, clause 28 of the Motor Vehicles Act 1988. So then now we go to Motor Vehicles Act. What does it say? Any mechanically propelled vehicle adapted for use upon roads and all those things, and includes a chassis to which a body has not been attached and a trailer. So all these things are considered as a motor vehicle. But in this Motor Vehicle Act, while defining the same, there has been certain exclusions, but does not include. These items are not considered as motor vehicles. So we need to have a look on these things. A vehicle running upon fixed rails is not a motor vehicle, so it becomes eligible to claim ITC. A vehicle of a special type adapted for use only in a factory or in any other enclosed premises. This will be very much important in case of manufacturing industry, even though the invoice or the some documents or the understanding of the people, they may consider it as a motor vehicle, but we need to see whether it falls within this category. If it falls within this category, definitely they will be eligible to claim ITC. And for the rest of the cases, what it is given is that a vehicle having less than 4 wheels, it should have less than 4 wheels, engine capacity of not exceeding 35 cc. So if it fulfills this condition also, in case there happens to be a vehicle of this category, definitely it is not a motor vehicle as per the definition. So we can claim ITC based on the definition of motor vehicle. So Then we move on to the next clause of subsection 5. Food and beverages, outdoor catering, beauty treatment, health services, cosmetic and plastic surgery. So these items are not available as input tax credit to the registered person. Exception being when it is used as an inward supply to make the same outward taxable supply, when provided by an employer under a statutory obligation. Say, for example, an outdoor caterer avails the services of some other caterer in helping to provide his service. So, whatever inward supply he has received from some other caterer, he can claim input tax credit for such transactions. But in a normal case, if a registered person avails the services of outdoor catering and an invoice is given by that caterer, that bill will not be eligible. Similarly, these catering and whatever be the food and beverages services provided by the employer, under statutory obligation, it will be eligible. But under voluntary basis, if the employer provides certain services, then that will not be eligible for input tax credit. So the next clause is with respect to membership of a club, health and fitness center. So again, if it is under the statutory obligation to the employer, he can claim it. Otherwise, these kind of services availed will not be eligible. Life insurance and health insurance is not eligible except where, again, an obligation for the employer by the government made as an obligation, and inward supply availed as an inward supply so as to make an outward supply, like in B above. So in such cases, it will be available. Now we need to see that health insurance, due to this COVID pandemic, there may be a lot of cases where either the assessees for themselves or for their employees, they might have taken certain insurance, maybe both life or health insurance, something like that. So we need to ensure that whether it is backed by any government GO or any obligation stating that employer has to make certain arrangements for insurance. In such case, if it is there, it is well within the right of the assessee to claim those credits. The next one is a travel benefit to employees on vacation or home travel concession. So if it is a statutory obligation, employer can claim it. Otherwise, it will not be possible. Now we move on to the most important aspect of blocked credit, which is works contract. Works contract services. So as per Schedule 2, works contract is declared as a service. So the works contract service for construction of an immovable property is not eligible. So the important aspect is that there should be a construction of an immovable property by way of works contract. So works contract will include both goods and service, supply of both goods and service will not be eligible. But again, there is an exception. When it is used as an input service, the example what we saw for outdoor catering, like that, if a contractor gets an inward supply of works contract, he gives a subcontract, so he receives certain services, he uses it and provides an outward supply of works contract service. For him, it will be eligible to claim input tax credit. In case the immovable property is plant and machinery, so anything with respect to the plant and machinery, input tax credit is available. It has both of these things have been given as an exception. The next item is inward supplies received by a taxable person for construction of an immovable property. So here we saw works contract, but next one is that inward supplies received by a taxable person for construction of an immovable property. Here also, other than plant and machinery, on his own account, even when such supplies are used in the course or furtherance of business, is ineligible. For example, an assessee constructs his factory building or his administrative office, anything, something, godown or so, whatever it may be. So construction of an immovable property, he receives inward supplies, but it should be other than plant and machinery. So even if it is in the course of furtherance of business, it is not eligible. Now we will see in two classes we have. In the first class we have seen works contract. So what is works contract as per the definition that we need to see? So works contract means a contract for building, construction, fabrication, completion, erection, installation, fitting out, improvement, modification, repair, maintenance, renovation, alteration, or commissioning of any immovable property. This is a very crucial thing. So, wherein transfer of property in goods is involved in the execution of such contract. So, what if only the name is works contract, but there is no transfer of property in goods, it will not qualify as a works contract. So, the blocked credit concept will not apply. Secondly, if the works contract for carrying out this kind of activity is not for an immovable property, if it is for something else, but it is a works contract. So it could be, say, for example, a works contract for installation of computer systems, where both supply of systems as well as service nature is involved. By simply saying the term works contract, we cannot say that it is an ineligible credit. So we need to examine in detail to see whether it is an immovable property. If it is an immovable property, it is not eligible. Otherwise, it will be eligible. In one of the classes, we have seen construction is not becomes ineligible for input tax credit, both in class F and class G. So what it includes is that it includes reconstruction, renovation, addition, or alteration or repairs to the extent of capitalization. To the extent of capitalization, this is very crucial. So the thing is that already we have seen the definition for capital goods. So whatever is capitalized in the books is called as capital goods as per GST provision. Again, now in construction activity, it says capitalization. So we can explore the possibility of tax planning where the capitalization is not there, where it may be possible. Say, for example, a leased land where construction activity happens. So how it will be taken care in books of accounts? What is the treatment for income tax, whether it will be capitalized in our books, depending on that. If it fulfills this condition, that is, it is not capitalized, then definitely credit will be eligible. But it is for us to examine in detail and also to make all the documents, related documents properly filed, so that any later on notice or inquiry may be suitably replied upon. Apart from the works contract and construction, there are certain other activities which are blocked. Inward supplies on which tax has been paid under composition scheme. Inward supplies. These inward supplies on which tax has been paid under composition scheme, it is not eligible. Received by inward supplies received by a non-resident taxable person, except goods imported by him. So this we need to consider as an important point. There may be cases of non-resident taxable person, even though the possibility is remote. In case such persons ask us to take a registration as a non-resident NRTP registration, which is valid for 90 plus 90 days only. In those cases, in case if we import certain goods, those will be eligible. Then the goods or services used for personal consumption. This we have already seen. It is covered in section 17.1 also. It says in 17.5 also it is clearly given that anything that is used for personal. Say for example, you might have definitely come across a case where our own assessees buy some articles. Say for example, some 84-inch TV for some trading office, a trading company or a trading business, and cycles, bicycles, 50,000, 1 lakh value. There are a lot of examples which we can quote. On the face of it, we can identify those are for personal use. So those items are not eligible simply because, and the another problem which we have is that the person who are selling any item which is ineligible as far as our assessee or the registered person is concerned, is that they say that if you give your GST number, you can get GST credit. The fact is that if we give the number, we will get entry in 2A. That is correct. But we are driven by 17.5 rather than entry in 2A. So that's what tempts even purchase of jewelry also to be included and claimed as input tax credit in a few of the cases to make it more dangerous for the assessees. Then goods that are lost, stolen, destroyed, written off, or disposed by way of gift or free samples. In case in case of some loss or theft has happened or destroyed, the goods have been destroyed in fire or something like that, what will happen is that we are supposed to reverse the ITC in case of those items. Similarly, as gift or free samples is also ineligible or blocked credit. But one thing we need to keep in mind, Schedule 1, Section 7 deals with supply. What is considered as a supply? There it is given that certain transactions are considered as deemed supply. So for supply, to be qualified as a supply, there should be some consideration. Schedule 1 lists 4 transactions which are considered as, which are deemed to be supply, even if it does not satisfy the conditions given in Section 7. Say for example, where the goods are disposed of. The thing is that you have, say for example, you have bought a laptop for the purpose of business, you have claimed ITC on it, you are disposing of that laptop to anybody without any consideration. So as per Schedule 1, it will be considered as a supply because you have claimed ITC on it. Similarly, any transaction between the related party, any import from a related person without consideration, transaction between the agent and principal, these 4 activities are covered under deemed supply provisions, Schedule 1. In case the gift or free samples are covered under deemed supply provision, ITC will not be blocked. ITC will be blocked only when there is no deemed supply provision. Here also we need to reverse those items. Then the last item as far as the blocked credit is concerned is that Section 74, 129, 130. 74 is nothing but which I told you few slides before. This 74 gives the proper officer the time of 4 years and 6 months from the due date of filing the annual return. Say for example, financial year 17-18, the due date for filing annual return was 3rd February 2020 for certain category of states. So for the 3rd February 2020 plus 4 years and 6 months. So up to 24 and maybe August 2024, in case of suppression, misrepresentation, willful suppression, misstatement and fraud, they can issue notice for 17-18 till August 2024. In case you have been served a notice, demand is raised and you accepted and you have paid it, it is blocked. You cannot claim it. Similarly, 129 and 130. This relates to detention of goods or conveyances in transits or towards the redemption of confiscated goods or conveyances. In case of e-way bill, in case the proper officer or the squad intercepts a vehicle and finds that there are certain items in the conveyance for which no proper invoice is there or e-way bill is not there, or if we have to bring certain goods for the purpose of transport, what are all the provisions to be complied with or not properly complied with, there they can impose tax, penalty, everything. If you have paid tax in those circumstances, again it will be blocked. So you cannot claim input tax credit on those 2 cases. So now we have covered Section 16 and 17. Now we come to Section 18. Section 18 is that credit in special circumstances. Actually, normally Section 16, as per Section 16, it specifies the conditions which we need to fulfill. But Section 18 gives a little bit room for the registered persons so that they can claim credit in a special cases. These special cases will not be normally included in our regular return, but we need to file a specific separate forms so that we can claim it. We will see one by one. Entitlement of ITC on inputs in stock and contained in finished goods or work in process and capital goods. So whatever the input tax credit which are in the stock of inputs, finished goods or work in process, as well as the capital goods, the assessee will be eligible in three different scenario. One is that at the time of registration or voluntary registration, on coming into regular tax paying status by exiting composite levy, that is shifting from composition levy to regular levy. Then in case of a person who has been supplying exempt supply, suddenly his supply has become taxable supply due to the notification of the government. In these three cases, the registered person is entitled to claim ITC in respect of stock. I would be interested to know from members how many of them have used this option by filing the relevant ITC form, because we can suggest it as a tax planning to our clients who have proper records, so that the act gives the permission to claim ITC at the time of registration as well as voluntary registration. This is a very big advantage if that person has some stock on the date of registration itself. If it is an altogether new business, the person cannot take benefit of this section, but in all other cases, they can very well claim benefit of this section. The second portion of this section deals with reversal of ITC held in the same kind of stock and capital goods. Why the reversal should come? The same reason as if the person exits the regular tax paying status and opts for composition levy. In such case, he might have already claimed ITC. Now he is going for composition levy. In such case, reversal should take place. Similarly, the item which was taxable till a particular time has become exempt supply. There also reversal is must. The third category with respect to this section is that whenever any capital goods or plant and machinery on which ITC has been taken is made as an outward supply by the registered person. Say, for example, one generator has been bought by the registered person. He has claimed ITC on it. He uses that generator for the purpose of his business. At the end of third year, he feels that it is not useful to him, or he wants to go for such some higher capacity. So he may sell that one and buy a new one. Whenever he is making a sale of supply of capital goods or plant and machinery on which he has taken ITC, that credit needs to be reversed, and whatever liability comes, it needs to be paid. That is an important aspect. So whenever we are doing this 9 and 9C, at the time of preparing depreciation schedule for income tax, we need to see, while preparing while verifying the block, any sale of asset has taken place. If so, whether it relates to the previous era or this period, GST era. If it is a GST era, any GST input tax credit has been taken. Those things we need to see, and based on section 18, we need to reverse the ITC. The last one is that transfer of ITC on account of change in constitution of the registered person. So there is a possibility that a proprietor may become a one-person company, or a partnership firm may become a company, or legal heir may inherit the business, a merger, acquisition, lot of things may happen. So in all those cases, eligible credit can be transferred to the new entity. The only condition is that the registration should be alive. If the registration is not alive, or it has cancelled at any point of time, then this transfer of credit will not be possible. So the four aspects which you have seen, we will see one by one. Normally, as per section 22, which deals with registration, registration needs to be applied within 30 days from the date on which he becomes liable for registration. Say, for example, this is we are in the month of August. So in case the person has become liable for registration, say, for example, he has made an interstate outward supply on 1st August, 1st August, or say, for example, a partnership firm has obtained a GTA service or a lawyer service or a sponsorship service where RCM applies. In such case, the date on which he becomes liable to registration, within 30 days he has to apply. If he makes the application within for 1st August, if he makes the application within 30th August, in such case, that person will be eligible for input tax credit for inputs held in stock as well as contained in semi-finished or finished goods. That is one thing. As on the day immediately preceding the date from which he becomes liable to payment. So, as per our example, 1st August is the date when the person is liable for registration. So, whatever is there in his stock in the semi-finished goods, finished goods, and inputs, as on 31st July 2020, he can claim input tax credit on those items. The condition, only one condition is that this ITC to be availed within 1 year from the date of issue of tax invoice by the supplier. So the tax invoice issued by the supplier should be within the age of 1 year. The next point is voluntary registration. Voluntary registration is the case where there will be no statutory obligation as per section 22 or section 24, which deals with the mandatory registration. But in spite of that, as per section 25, various associates are making registration due to the compulsion of their customers or for various reasons they are making the registration. So in such case, if a person goes for a voluntary registration also, they will be eligible to claim inputs held in the stock as well as semi-finished goods, finished goods, the day immediately preceding the date of registration. So whatever be their date of registration, prior to that, whatever is held in here in the in the previous case, 30 days time is available. Even before 30 days also we will be eligible. But in this case, just preceding the date of registration, so they will be they can claim the ITC held in the stock. Whatever ITC is held in stock, they can claim. The third category which we saw was that from composition, the person switches to the regular one. In such case, apart from the inputs held in stock, semi-finished and finished goods, capital goods is also eligible. This we need to take into account. Any capital goods on which input tax credit is involved, provided depreciation is not claimed on that component, we can very well claim ITC. Here, the day immediately preceding the date from which he becomes liable to pay tax under the regular scheme. Say, for example, now he is under the composition scheme. From 1st September, he is switching over to regular scheme due to the reaching of turnover of 1.5 crore or whatever may be the reason. So, whatever he is having his stock as on 31st August 2020, he can claim input tax credit on those things. Then again, exempt supplies, which becomes taxable supplies. Inputs held in stock as well as contained in semi-finished goods. Capital goods exclusively used for such exempt supply. These two categories are eligible to claim ITC. Here also, day immediately preceding the date. For the composition scheme to regular scheme and from exemption to taxable supply, certain conditions are there which needs to be fulfilled. One is that capital goods, the ITC on capital goods will be reduced by 5% per quarter because we cannot take the full ITC as such because certain years might have lapsed since the purchase of the capital asset. So we have to reduce 5% per quarter of a year or part of the year from the date of invoice. Whatever amount comes, that will be eligible to claim. Then the ITC claimed shall be verified with the corresponding details furnished by the corresponding supplier. Whatever ITC we are claiming in these two categories will be cross-verified with the supplier. Again, the same condition, it should be availed within 1 year from the date of issue of tax invoice is a must. In this entitlement of ITC for the new registration and switch over from composition to taxable regular supply or from exempt supply to taxable supply, we need to keep in mind certain points. One is that credit on input service is not available in any of the categories. You might have seen that what is available is only credit of goods and not credit of services. Similarly, we need to file declaration in form GST ITC01 within 30 days from the date of becoming eligible to input tax credit. This is a must. So if you have filed GST ITC1 online, then we will be able to claim those items. Within 30 days is must. In case the amount so claimed exceeds 2 lakhs, so certificate from us or a cost accountant is also a must in order to make the claim available. Reversal of ITC. Reversal of ITC is that we have already seen from composition levy, if the person is exiting, if the person is in a regular tax regime and he goes out of regular tax and he opts composition levy, whatever ITC on inputs he is having on the as on date of his stock, that needs to be reversed proportionately. ITC involved in remaining useful life of the capital goods. The same way how we worked out 5% per quarter for claiming the ITC, when we are moving back to composition scheme, the useful life of asset will be taken as 5 years in all cases. There we have to work out the remaining useful life and we have to reverse the ITC. And this is the third category which I was discussing earlier. In case the registered person makes an outward supply of capital goods or plant and machinery. In most of the places, the Act uses the word plant and machinery along with the capital goods. So they are not sure whether plant and machinery will be included in capital goods. So they want to make it clear. So in a number of occasions, they use capital goods or plant and machinery. So if you have already taken ITC on these things, and if he is making an outward supply, we have to reverse it, and it will happen as higher of the following two figures. Whatever is the ITC taken on such goods reduced by 5% per quarter, or tax on the transaction value. Tax on transaction value is that in the generator example which we saw, if the generator is sold for some 3 lakhs, and if it is in the 18% category, the tax will be 54,000. And whatever ITC you have already claimed, then working out a reduction of 5% per quarter of year or part thereof till from the date of issue of invoice till this date, if it happens to be some 48,000, so we have to make a payment of 54,000 by reversing the amount from the ITC ledger and whatever is the extra amount that we need to pay. So ITC involved in the remaining useful life will be taken as 5 years across all provisions. If refractory bricks, molds, dies, jigs, these items are supplied as a scrap, then the taxable person may pay tax on the transaction value alone without working out the ITC portion. So transfer of ITC is possible in case the change in constitution of a registered person, like sale, demerger, amalgamation, merger, whatever is there in the electronic credit ledger, that can be transferred to the new entity. Provided there is a specific provision for transfer of liabilities in such change of constitution. We have to transfer liability also. Without that, ITC cannot be transferred. Then what is the interest liability? We have seen various items where ITC needs to be reversed or certain conditions needs to be fulfilled to claim ITC. We have seen that in section 17.1 and 17.2 as per rule 42 and 43, ITC related to the personal consumption or ITC related to the exempt supply needs to be reversed. If it is not done, rate of interest attracted will be 18%. It will be from the start of the following financial year till the date of payment. Say for example, financial year 1920, we might have claimed an ITC of say around some 20 lakhs. The person provides both taxable supply and exempt supply. As per the formula, we have to work out the common credit. Hopefully, we might not have taken the credit, exclusive credit related to the blocked credit, personal items, exempt supply. These, if we have not at all claimed in 3B, that would have been very good. Apart from that, we have to work out the common credit. From the common credit, by using the formula exempt supply divided by the total supply, we have to arrive at the figure. That figure, reversal for exempt supply or personal consumption, needs to be reversed by GSTR3B of March 2020 for the financial year 1920. If it is done, no interest is attracted. Most of us, due to this lockdown and other issues, we might not have worked out those figures. So now what will happen is that from 1/4/2020 to the date we are making the payment or reversal, interest will be attracted. Then payment to supplier should be made within 180 days is one of the conditions which we saw. If we don't make the payment, we have to reverse it. Here, from the date of availing the credit till the date of reversal, we need to work out the interest. 2 points needs to be considered. For arriving at the interest, the date is from the date of availing the credit till reversal. To work out the 180 days, whether payment is made within 180 days or not, the date will be counted from the date of invoice. That is very important. Mismatch of invoice, the 10%, 2A matching, all those things, 24% is the interest rate from the date of availment till the date of reversal. Wherever we have availed more than the percentage or not matching with 2A and all those things, that is, so the latest developments. In the latest GSTR 2A, import of goods or services is also included. So far it was not there. Now it has been made that import of goods and services is also getting reflected. Now we can check the import transactions also. So after that, the only item which will not be reflected in 2A will be RCM transactions. Then they have announced a new statement of GSTR 2B to be generated on a monthly basis. It has so far not come into operation. What is proposed is that the 2B will take the information from 2A and it will give the details only with respect to a particular month. So the information will be static, unlike 2A, where the information will keep on updating based on the filing of GSTR1 by the supplier. Here, the 2B will be static for a particular month. If it happens to be July 2020, the information will be, once it is taken out, it will be final, what are available in July 2020. And it also proposes to specify the cases where ITC is eligible and not eligible. ITC is not eligible. How can they decide whether a particular ITC is eligible or not eligible, even when it cannot be determined by the assessee himself or their chartered accountants? But they have restricted this only to 2 cases. One is that where the invoice date is beyond the permitted date, the system itself will show, say for example, if the invoice date which is populated for August 2020 relates to some 18th September 2018, something like that, not related to the financial year 1920 or 31/3/2019, then it will show it is not a eligible for input tax credit. Similarly, say for example, we are in the state of Tamil Nadu. If the registered person goes to the state of Karnataka and avails the lodging services, he will get an invoice for CGST and SGST. If he has given his number and that person has also uploaded the invoice in 2A, in 2B it will be shown as ineligible credit because the place of supply is in Karnataka and the person is in 33, he is having a registered person, place of business is in Tamil Nadu. So directly the system will show it as an ineligible credit. So only these 2 categories they have taken. Under the regular section 17(5) and section 16, it is for the duties cast on the assessee to decide whether it is eligible or not. Recently, the government has made an amendment in Rule 86A. We have been coming across the news of swindling crores and crores of rupees due to fraudulent availment and utilization of input tax credit on just what you call as letter pad companies and non-existent companies. Even in our own place also, some construction company people got arrested by investigation wing. Something like that happens day in day out. So they have made Rule 86A by empowering the officer not below the rank of assistant commissioner, that even if you claim input tax credit, even if you avail input tax credit and it is reflected in the electronic credit ledger, the AC can pass an order if he has reason to believe that the credit was availed fraudulently, that is fraudulently, or the invoices have been issued by the persons who are not at all in existence or not at all having a place of business as mentioned in the invoice, or the person who have claimed availed the ITC has not received the goods or is not in possession of the invoice, or the taxes specified in those invoices were not paid by the supplier, or the credit availed, the person who has availed credit himself is not at all in existence, or there is no such place of business for such person. So if it happens, if the AC or the officer above the rank of AC has reason to believe that these circumstances are prevalent, then they can very well, they have the power to make it whatever credit in the electronic credit ledger, you will not be able to debit that amount. This restriction will be for a period of 1 year, within which definitely department will also be willing to finalize the case, because if it happens to be a fraudulent case, then they will impose penalty and they may go up to the act of arresting the person. If it happens to be a genuine case and due to some communication gap or improper filing, then they will remove this restriction. The person can avail they can utilize the credit availed. Considering this, the definition of place of business becomes important. Place of business includes a place from where the business is ordinarily carried on. It also includes a warehouse or godown or any other place where a taxable person stores his goods, supplies, or receives goods or services, or both. So all these things are considered as place of business. A place where taxable person maintains his books of account. Hopefully, this is not the place of our office. A place where taxable person is engaged in the business through an agent. So where it is done through an agent, that is also a place of business. Place where maintaining his books of accounts and wherever he stores goods is also a place of business. So we have come to the last discussion, last area of our discussion. In section 16, we have seen that the credit should be utilized in the manner specified in section 49. Once the credit has been availed, satisfying the conditions given in 16 and 17, and the extra credits available in 18, the person can set off, excuse me, or utilize the credit for making payment to the government. So for that, the recently Rule 88A has been amended due to the sharing of revenue between interstate and intrastate, central government and state government, and various problems faced by the government. They have made it as a rule that whatever credit is available in IGST, ITC available in IGST should be exhausted first before utilizing the CGST or SGST. Then if after setting off IGST credit, if anything is left over, that can be the same IGST ITC, if left over, can be utilized towards payment of either CGST or SGST in whatever order the assessee prefers. Previously, the order should be IGST, CGST, and SGST for setting off the ITC of IGST. Now, after clearing the IGST liability, balance ITC of IGST can be utilized either for CGST or for SGST according to the will and wish of the assessee. But I have come across a case in one of our client's case where we were setting up the person was having a liability to pay under CGST and SGST. He was having a credit of IGST, CGST, and SGST. So if we just as a layman, if we add all the output tax liability and deduct all the input tax liability, his net outflow requirement was, say for example, some 2,400. But when we when the system itself sets off, it shows the set off and generates the challan for us by using the set off facility. It shows that we need to pay a sum of rupees 5,700, something like that. Then we again went back and see how it makes set off is that it is setting off only the IGST liability to the full, to the extent possible. Then the balance amount is not set off according to the ITC available under each head, which is beneficial to the assessee. So in those cases, what we can do is that we can work out separately in an Excel file, and then we can do our own set off in such a way that IGST is fully exhausted, and CGST, SGST is also exhausted to the extent possible. Then we ended up paying only 2,400 instead of system set of showing an amount of 5,000 or 6,000, whatever it may be. So while whenever the assessee is having a credit in these cases, we can ensure that the set off is beneficial to the assessee. Apart from that, a few items which I would, thought of sharing with you was that from 21st August 2020, now the GST registration is Aadhaar based. We have to submit our application. Previously, in the first page itself, we will be giving our Aadhaar number and marking a tick that I agree to share the information with UDAI or something like that. But now there will be no provision in the first page. We have to submit our application. We will receive a link. We can either get the link by logging into my services or in our email. There we need to give our Aadhaar number. That will be validated with an OTP. So the person applying should have Aadhaar, and his Aadhaar should have either mobile number or email. So the OTP can be received in either one of it. Both are not mandatory. Initially, there were some hiccups for the first week, but now it is settled. So whenever you get an OTP in SMS, you can give that OTP and verify it. Once Aadhaar is validated, authenticated, then only ARN will be generated. Till such time, the application will not be submitted. That is one thing. Another thing which I would like to share is that there are a lot of AAR rulings, Authority for Advanced Ruling, which is shared in the social media and public domain, stating that ITC on lift is not eligible, ITC on this is not eligible, or whatever it is, the residential complex ruling has been given, something like that, all those things. My personal humble opinion is that Authority for Advanced Ruling is applicable as per section 103 or the related provisions, is applicable only to the person who is making an application for that, and for him also it applies only to the extent of the facts and circumstances given in that application. In case the facts and circumstances given in that application changes, the same ruling will not be applicable for him also. So that is one of the point which we need to consider. Then the thing is that is not applicable to any other assessee. Similarly, the department cannot also use that application, whatever be the ruling given by the Authority for Advanced Ruling, for making any assessment or for whatever be the purpose. So we need not consider give that much importance to AAR, and moreover, I personally feel that Authority for Advanced Ruling is not yet properly designated or designed as far as GST is concerned. The reason being that the authorities, that is the officers, the persons who are posted in the Authority for Advanced Ruling is only from the department side. there is no representation from the judiciary or the person who is not an interested person. So in such case, an officer up to a certain level of rank from central government, CGST and SGST will be there to make the ruling for advanced ruling, whatever be the application made. So in such case, it is natural that in most of the cases, they may tend to be pro-revenue, unless otherwise it is again went to the, it goes to the appellate authority for advanced ruling or some NAC, whatever NAAC, whatever they are, national authority for advanced ruling. If only it goes to all those authorities, we may expect a reasonable advanced ruling cases, because otherwise we can see whatever ruling that we are getting reported is that they say that everything is taxable or ITC is not available, something like that. So we need not be guided by those advanced ruling, even though as for academic interest we can go through those things, but we need not worry about the rulings unless it is made applicable by way of amendment in the CGST Act or in GST rules. We need not bother about it. I sincerely thank each one of you for sparing your valuable time in listening this lecture on ITC, and I also thank our branch staff, Mr. Satish, who helped in making understanding of these nuances of using the Zoom. Thank you one and all for your patient listening. Thank you.
Thank you, sir. Thank you for your valuable presentation. Sir, members are requested to raise your queries. Sir, we have a few questions through chat box.
Yes, sir.
Shall I read, sir? Have you view that one?
Yes, sir. Just a minute. I will open it. Sir, if by oversight we have failed to reverse ITC for not making payment within 180 days and have paid the amount after some time, then whether it would be enough to pay interest for the intervening period. Sir, presume that the oversight is detected only at the time of departmental audit. Yes, sir. Again, we need not reverse that because it will happen both on the same day. The reversal as well as claiming will happen only on the same day. It will have no impact. But if we pay the interest, that is enough. Input supply of racks, lift, lighting, and interiors of a jewelry shop eligible for ITC. Racks, lift, lighting, and interiors of a jewelry shop eligible for ITC. Sir, there is as far as the eligible for ITC is concerned, we are supposed to see section 17, subsection 5. So if the item is not specifically covered in any one of the classes of 17.5, prima facie, in these cases, it should be available. But at the same time, it will be risky to give an opinion without knowing the full facts about how they have made the transaction. Is there any agreement? And interior means what? Whether it involves any capital item and those things. We need to have a close look at it. But prima facie, ITC will be eligible. Goods lost or destroyed, etc., will include invisible loss. So invisible loss, invisible, it is a good question actually. I think Sir is referring to the cases where manufacturing input-output ratio happens, certain losses happens during the course of manufacture. For those things, reversal is not required and it is not possible also, sir. But when, say for example, the godown is, entire godown is gutted by fire, or some during transportation, certain goods have lost, something like that, only those things it is included.
Sir, any other questions raised by any members? Members are requested kindly raise your queries through chat box or raise your hands. I will enable you. There is no question, sir.
Either I have clearly explained the provisions of input tax credit so that there is no doubt. or whatever is there, we will see. And I once again sincerely thank each one of you, sir, for your participation in large number. Thank you, sir.
Sir, thank you for your valuable time sparing and immediate acceptance of our today's session. I herewith request our secretary sir give a vote of thanks. Secretary sir, floor is yours.
Good evening, everybody. On behalf of the Erode branch of CARC of ICAI, I hereby thank CA R.Krishna Kumar, our own member, who has made a very detailed presentation. Sir, in fact, actually, the presentation was very detailed and it has covered actually step by step. So that might be the reason for actually not asking many doubts. And you went in a very, very steady manner, so that you have not rushed through at any part. So it was very interesting throughout. I sincerely thank you, sir, for your valuable presence today.
Thank you
I
very
also
much, sir.
thank all our senior members and members for making this event a grand success. Thank you, one and all. Thank you very much.
Sir, thank you, sir. Thank you so much, Krishna sir. Thank you for all the members. Thank you.
Thank you, sir. Thank you very much, sir.
So much. Thank you.